That's a great question, Rohan. Thank you for asking it. I'm not sure if what I say will be the answer you're looking for, but there are business models, different business models in the resource extraction world, which is where we sit along with minerals and mining and all these other kind of resource extraction industries. And the world is divided into two. There is the concessional model and the contractual model. The concessional model is where ownership of that resource, say an oil and gas reservoir, is given to the company to exploit at their own risk and sell at their own risk and cost. And the owner relinquishes ownership in return for corporate taxation. That's one model. But so that model exists in the developed world, if I may say, the US, the UK, the North Sea, Australia, many places. Many places the resource is just given to the developer. The developer develops it, and if the developer is profitable, the government gets something out of it, and the government gets that out through tax. We live in a contractual world where we actually own the resource. It belongs to us. Us means you, the people, the republic, and we require that anybody who produces that shares it with us. And that's a slightly more economically difficult model to work with for oil and gas companies. Oil and gas companies like to be unconstrained by production sharing contracts, conditions, etc. So we are at a slight disadvantage. This contractual model is mostly prevalent in the developing countries. It's present in the Middle Eastern countries in a different way. Yes, the resource, the state, let's say Saudi Arabia or the United Arab Emirates, owns that oil. But it pays per barrel produced. It's called a service contract. So there is a very clear incentive for people.
Very good afternoon to everyone who is in the platform, and let me warmly welcome all of you on behalf of APIT Sri Lanka, Asia Pacific Institute of Information Sri Lanka. I'm sure we have been meeting you in different topics, talking about different hot topics and challenges from time to time. But today, indeed, is also going to be a very interesting, very engaging discussion, which will give you a new perspective. So with that, let me warmly welcome all the students who are joining us from Staffordshire University and all the delegates and diplomats who are joining us from different parts of the world, and our counterpart university members from Staffordshire University and all the other county universities as well. In addition to that, the corporate distinguished guests who are with us today, a warm welcome to you as well. So to start off the webinar for today, let me warmly welcome our chairman of APIT Sri Lanka, Mr. Bandule Godage, to officially welcome you to start the session. Chairman, over to you.
Thank you. Thank you, Kaushali. Today is also another great day. I don't think that I should, whoever should not introduce this gentleman for today's appearance. I think, first of all, on behalf of our CEO and the board of directors, and also the APIT population, the teachers, the big thank you for you, Mr. Saliya Wickramasuriya, for joining us today in spite of busy schedule. So it's a great honor to welcome you, and also in a shorter version, of course you are here. I mean to share your knowledge and your experience with all Sri Lankan or maybe international student population for their betterment of their life. So it's particularly the moment we hear you. I mean, it is basically your name itself is a hot topic for Sri Lanka. Or maybe at this it's a current topic. So anyway, first of all, thank you very much for being with us. APIT known for years for the quality education, the great initiatives that Dr. Rohanta Atukorala created to give the right opportunity to mix with the great opinion leaders like you for our student population. Today we are having another very important session along with you to give that opportunity for our students. If you recall the long time ago, I mean, as students, we didn't have that opportunity. I think it's a great thing. All our students to get in touch with the opinion leaders, to have a direct contacts and question and answer session to improve their knowledge. and by gaining that knowledge and in return they can give it back to the society in a bigger way. So that is the whole intention. More than the academic excellence, from our university we expect people to be well-rounded people. So that is the whole objective of having this program. That is why you are there, Mr. Saliya Wickramasuriya, to be with us today. It is the objective. I'm sure very warmly welcome all the participants today, and also joining us with the diplomatic corps and many other external people and students, and also the teachers especially for this session. So without further ado, I mean, with the value and respect, I'm sincerely thank you for being with us once again, Mr. Saliya Wickramasuriya. So I think I will I hand over it to Rohanta and Kaushali for the next proceedings. Thank you very much.
Thank you very much, Chairman. It's actually an honor for me to introduce our speaker today. Like you very rightly said, he's a hot topic, maybe somebody who can actually wipe away our $51 billion debt, from a stroke of a pen, I believe. So here he is. He joined the upstream oil and gas industry in 1984, working for Schlumberger, the world's largest petroleum service company. Following 20 years in oil exploration worldwide, he returned to Sri Lanka in 2004 and was appointed Chairman Director General of the Sri Lanka Board of Investment. He was the chairman of the Sri Lanka Ports Authority from 2006 to 2009, after which he spent 3 years back in the international oil and gas sector. Returned to Sri Lanka in 2011, he spent 6 years as the Director General of the Petroleum Resources Development Secretariat, an institution tasked with developing the country's emerging upstream petroleum industry. He's also the co-chair of the Energy Committee of the Ceylon Chamber of Commerce since 2017, was appointed member of the Colombo Port City Economic Commission in May 2021, acting as the Director General role until it's permanently filled, and is also the chairman of the Petroleum Development Authority of Sri Lanka, the newly created upstream petroleum regulator. Ladies and gentlemen, it's actually an honor for me to introduce a person whom I have a lot of respect for. When he was chairman of BOI, he's the chairman of the Board of Petroleum Development Authority of Sri Lanka, Saliya Wickramasuriya. Over to you, sir.
Thank you, Rohanta, for that most flattering introduction. I can hardly recognize myself. And thank you, Chairman, for your kind words too. It's a privilege to be in the company of old friends, and in particular, it's a privilege to be in the company of young minds. So let me get right on with it, so that I could perhaps stimulate some questions from the audience at the end. Now, let's start with the easy one first, which is the very often asked question: does Sri Lanka have her own petroleum resources? And the answer to that is a very definitive yes. Yes, we do. Now, why do I say that? I say that with some confidence, because in the oil industry, there are degrees of classification of reserves. Reserves is the term that we use to denote accumulations of hydrocarbon. It means a lot of other things also, in terms of currency too, but in terms of the oil and gas, it means, do we have any accumulations of oil and gas? We won't, on this short webinar, go into the discussion on how oil and gas is formed. We'll leave that to you guys to Google and find out the current wisdom on how that process is interpreted. But right now, let me confirm to you that Sri Lanka does have what we call in the industry 2P reserves. Now, that's an interesting term, and you would probably not have heard it before. So I will very quickly explain what that means. The P's that I refer to are proven, probable, and possible. So if you think about it, due to what you're going to hear a little bit later on, the ability to estimate exactly how much hydrocarbon or petroleum is in place at a given time is a little difficult. It isn't possible to quantify it exactly. However, certain things can be done to make ourselves fairly sure that we have at least this much oil and gas in place. That is called P. And reserves that have that degree of confidence are called 1P. 2P is proven and probable. So an extrapolation of what we actually have with a high degree of confidence is what we would most likely have under certain conditions. That's 2P, proven plus probable. The third P, possible, is the largest number because it's a fairly generous quantification of an optimistic estimate of what there might be under the ground in a particular place at a given time. So if that makes sense to you, then Sri Lanka has 2P reserves, reserves that are proven and possible and probable. Proven because they have been recovered, tested. We have dry gas and condensate and light oil. And we've actually chemically analyzed the samples. We have quantified the reserves in which they exist. And from that standpoint, we are fairly confident that we have mixed multiple petroleum systems. In other words, different geochemical processes taking place in Sri Lanka, offshore Sri Lanka, which gives us a high degree of confidence that there is more than what we have just discovered. There is the rest, there is others. And that's the advantage of having a basin with potential. And a basin means a place where oil and gas can accumulate. And once the potential has been tested in one particular place, the confidence across the whole basin spreads up. So now that's the first question answered. Yes, we do have. The second question that people ask us all the time is it commercially viable? And the answer there is it's really up to us to make it commercially viable, us being the government of Sri Lanka, who is the owner of this resource. So if the government of Sri Lanka takes a particular position with respect to the resource sharing agreements we enter into with potential partners, in other words, we call it the fiscal regime. In other words, is it worth coming to Sri Lanka, going somewhere you haven't been before, setting up shop in a place that doesn't have a proven industry and producing oil and gas into a market that is a little bit unsure? We have to overcome a certain amount of reluctance initially, because don't forget, there are plenty of other places that do have oil and gas and are producing it and supplying the market with it. So why come to Sri Lanka unless there's a good compelling reason? Now, from that point, we can and must and should and will make it commercially viable. The next step in that questioning process is, how do oil and gas companies make these decisions? In other words, how do energy companies that don't exist in Sri Lanka and have fields of operation far and wide, how do they decide to come to a place like Sri Lanka and sink a large investment in exploring for and producing oil and gas? The first part of that, the answer to that question is potential. If a place has no potential, then it doesn't draw much attention. I won't go into too much details on the potential part now. We haven't got time because there's more interesting stuff coming. But by having 2P reserves, we have ticked that box. To most people, we have potential. It's exploitable, and there are hydrocarbon systems present. Gas and condensate has been discovered, recovered to the surface, tested, sent across the world to be analyzed chemically. So that part, the potential part, is there. The other part is, what are the risks and uncertainties? Now, those are two words that sound similar, ladies and gentlemen, and they are similar, but in the oil and gas sector, they are quite different. Let's first talk about risk. Now, we're talking about Sri Lanka, we're talking about potential, we're talking now about risk. We have potential, we also have risk. Oil and gas companies look at risk in a simple way. They look at above ground risk and below ground risk. Below ground risk is technical risk, geotechnical risk, partly addressed by the discoveries we have and the chemical analysis that gives us the origin of those hydrocarbons, identifies the source and migration paths, etc., etc. The other part of the geotechnical risk is how do you get what's there to where it can be sold, which is to the flange, to the shore. That's also part of geotechnical risk, but this current day and age, we are no longer on the frontier of oil and gas production. We have become over the years, due to technology advances everywhere else in the world, quite an easy environment to manage. Even though we are deep water offshore, we're still quite standard when it comes to technology available and applicable to produce hydrocarbons found in Sri Lanka. That moves us on to above ground uncertainty, above ground risk. So what is above ground risk? Now that part is a little bit more sensitive. Above ground risk is everything in the policy, legal, political, and geopolitical framework that could affect an investment. Oil and gas companies have a fairly thick skin when it comes to above ground risk, because some of the places that I myself have worked in have been either pre or post war. Some of them have been actually engaged in war at the time. So really, when it comes to risk, the way you and I see it, oil and gas companies look beyond that. What they're looking for is, does this place that they're going to have a policy framework? Does this place that they're going to have law that provides equity, regulation, and a certain amount of investor protection? Does this place have an active and efficient mechanism of regulation and enforcement? Is this place stable politically? Is this place stable geopolitically? What are its politics in terms of foreign relations? Those are the things that have a price attached to them, which oil and gas companies look at. So let's go back just a second. Risk above ground, risk below ground, and potential. The last word that I would like for you to register in your mind here is uncertainty. The oil and gas industry is all about risk and uncertainty. Actually, it's all about potential risk and uncertainty. Now, uncertainty is to be expected below ground. So while there is below ground risk, there is also below ground uncertainty. By uncertainty, what I mean is, how exact can we be in our measurements of certain parameters? Let's leave it there for a moment. Let's go to the above ground part. Now, yes, we have risk, but we shouldn't really be having any uncertainty there. Above ground, the environment that is presented to an investor who is expected to spend millions, hundreds of millions of dollars producing oil and gas can't have much uncertainty. And that is under the government's control. It could be fiscal uncertainty, tax uncertainty, policy uncertainty, legal uncertainty. Everything should be cut and dried, very directly measurable and stable and trustable. That's where the government work really needs to go. There's also the only thing that's above ground that oil and gas companies have some degree of tolerance for is market uncertainty, meaning what's happening in the big wide world and external market. And they have usually a big room full of people that help to predict and hedge against those things. But on ground, we really want to minimize the uncertainty attached to the risk that's above the ground. So I hope that makes sense. Now let's go back to uncertainty on the below ground part. So we know we have potential, we know we have oil, we know we have gas, and but how much do we have? How sure about that are we? Can it be produced? Can it be commercially produced? All of that doesn't have a simple answer. Remember, this is not an investment that gives you a return that's very predictable. It's not putting up a factory, setting up a manufacturing plant. It's a bit more like investing in learning. What you do with it is what you do with it. Here, you have to deal with a little bit more than that. You've got to deal with the possibility that your measurements are not accurate. And what is accurate here is not the same there, because underground, subsurface, below the seabed is not uniform. So from that standpoint, oil and gas companies put to the very forefront of the picture sets of various financial tools. So let me give you an example. If somebody is wanting to sell you a business, and many of you are MBA students, I'll put it in that context, decision-making in that context. When they want to sell you a business, they want the best price and you want the lowest price, lowest cost, and they're going to give you the highest confidence and you're going to build into it the maximum risk. In other words, they're going to tell you, my shop is always full, there's people always buying stuff, where people come in day in and night, and you're going to build a business model that will ultimately justify your purchase price. Now, here's where you've got to be a bit careful in the oil and gas sector. You can't take single dimension numbers. If I say to you that we have 3,000 barrels here, I am not sure of that. I can't be sure of that because it's scientifically not possible to be so sure. So there's uncertainty in those. That uncertainty must be modeled. Now, if you were to believe the best case scenario that the business seller tells you that their business is worth so much, you may discount it in a certain way that you're familiar with, you're used to. But even that's not enough. It's still a two-dimensional number. It's just a number with a discount and some conditions. That's still 2D. We need a little bit more uncertainty than that. So what we have to do is we have to reconstruct the financial equation that gives us the ultimate result, which is oil or gas or profit, whatever the ultimate number is. We have to identify each and every one of those factors that contribute to that. Now, take, for example, when you're looking at oil and gas reserves, how much is there? So how much is there is a very simple question. It is the amount of porosity of that rock. Porosity is how much pore space there is, times something that the oil and gas industry calls the water saturation. In other words, the earth as we know it is always saturated with water, other than if there is oil and gas. There are no known exceptions to that. So if the water saturation is 1, then the oil and gas saturation is 0. If the oil and gas saturation is 1, then the water saturation is 0. So there is a mix in between. Even in a very high concentration of oil reservoir, there's always some water. And from that point of view, that number that you use in that equation, it's called water saturation, is a very important number. And you can't be sure that what is applicable in this particular place is applicable in that particular place. So what you do is you model this. You actually insert another dimension into this equation. You bring in probability, a distribution. Now, how much can the porosity vary by? How much can the water saturation vary by? How much can the volume vary by? How much can all of these variables vary by? So that distribution is an absolute must. So now you can see that just multiplying A times B times C times D with factors, giving you an answer, is not the approach oil and gas companies take, because it doesn't give them any confidence. It doesn't give them the confidence to make an investment decision. So what they do is they apply a probabilistic distribution to each of these, and they use the simplest distribution, most likely, least likely, and so shall we say best case, worst case, most likely. That's what they call a 3-point distribution. And then they apply a Monte Carlo analysis to the entire equation. So what you get at the outcome is not a single number, but a distribution. That distribution will tell you there is a so much percentage chance of us having this much, there's a so much percentage chance of us having that much, etc., etc., etc. Once that is done, then you can put pricing on that, you can put market conditions on that, you can constrain it in any other way, and understand really what pricing you are looking at. What is the amount that you should pay to produce? What is the amount that you should pay for this reservoir if you're buying it? What is the amount you should invest in it if you're actually operating it and producing it? which means that we have to apply a lot of financial project management tools to make comparison between competing projects. Oil and gas companies worldwide, they operate globally. They have operations in different countries, and Sri Lanka is just one place with potentially high perceived risk above ground, potentially high perceived uncertainty below ground, because we don't have any producing fields. There are no benchmarks. There is nothing that we can say, well, it happened there like this, and therefore it'll happen here like that. So we can't really have there's no legacy data we can draw on. So they have to select why Sri Lanka versus country A, B, C, D, fields A, B, C, D. Now, how they do that is they apply all of these numbers that you've heard about in terms of these tools, and I'm sure you're very familiar with that financial analysis. And then they crystallize that into some simple numbers. Net present value, these are all things I'm sure you're very familiar with. Net present value, return on investment, payback, return on equity, internal rate of return. Now, they each tell a different story. The company that's looking for the largest project in today's money will select the project that has the highest net present value. That may not necessarily be Sri Lanka. The company looking for the longest, the highest annualized return over the whole project lifetime, maybe oil and gas companies typically want to see 15 to 20% internal rate of return on the dollar. That now depends on the financials we provide, because how much do we tax them? How much do we demand that they share with us? How much are they permitted to sell in competition? There's a whole variety of other factors that determine the fiscal regime. But if our fiscal regime is attractive, then it somewhat compensates for other risks that they have to look at. So we do our best, in fact, to understand what the oil and gas company's objectives are in their exploration program and align with that in providing the most, shall we say, the most fit for purpose fiscal regime, because that's the only thing we can control. We can't control what's below the ground. We can't really control what's above the ground other than from the law. So really all we can do as a resource owner is provide really good policy, really good law, very clear separation of regulation, operation, and policy, active enforcement of regulation, equal treatment of investors. Those things we can do, and we can provide a favorable fiscal regime. And that would tempt people to perhaps come to Sri Lanka and take the risk of investing outside of their own areas of comfort. Now, in this picture, I have to come to a question that I touched on very briefly. How much will it cost? People ask us, how much will it cost to produce our oil and gas? So first of all, do we have? Yes. Can it be commercial? Yes. Now you've understood a little bit about how to make it commercial. How much will it cost? Fair question. That answer cannot be the input. It actually has to be the output of the discussion we have with the oil and gas company, because we can't set a price and then hope that everything else falls into place. What we do is we look at that equation, we do the best we can in modeling it, we do the best we can in deloading it fiscally, and then we agree on it. The argument goes something like this. So now we have both of us agreed that there is this much reserves in this particular place, and we're talking about that. And we think that an equitable distribution of this resource is such. And we think that as the investor, you're deserving of such and such an IRR. And we as the resource owner are deserving of such and such a volume. And when that discussion is had, the price actually drops out of it. So in summary, when we discuss production sharing, in particular, production sharing regimes, there are different regimes around the world. Sri Lanka is a contractual regime, which means we enter into a contract of resource sharing. We actually negotiate most on the internal rate of return. The price will only appear after that. So my last 2 minutes, I just want to point out to all of you that this approach, it doesn't have to be restricted to the oil and gas sector. This approach is what any sensible business owner should be applying to all their businesses, and any sensible government should be applying to all their projects, because in projects, government is sometimes the investor. I don't see that happening much in Sri Lanka. Our risk assessment of projects is very, very weak. Our assumptions are not tested. There is hardly any sensitivity analysis, hardly any probability analysis. What's the worst case, best case? So we as a society are not used to measuring risk. We bargain, but that's not risk mitigation. So I'm suggesting that when you get out there and back to your jobs and in your new projects and in your new jobs and whatever it is, apply a little bit of analysis so that you can optimize what money you actually minimize, what money you leave on the table, and optimize what money goes into your pocket. So I think that's pretty much 30 minutes. Thank you for sticking with me for that long. I'm happy to cease fire and take any questions.
Thank you very much, Saliya. It was really enlightening. We learned so much from what you were sharing. Many questions are coming up, but the first question they want to know is, this is the first time we are seeing an expert from the oil and petroleum industry. Could you kindly tell us what made you get into this area of work, and what did you study at university level?
Thank you. And to whoever who asked that question, the answer is very simple: by accident. I studied physics in the United Kingdom, and I applied to every oil company I could think of, because at that time in the 80s, they were paying well. So I just wanted to earn more money than my colleagues and friends. And I actually was lucky in getting selected for this particular company, and the rest of it is history. Accident.
Did you study for a master's program? And was that learning useful for today?
I didn't. I haven't done an MBA, nor any other kind of master's program. All I have is my bachelor's. The company I work for is fairly intense in setting high standards of performance and driving behavior, and therefore invests very heavily in training. So what little you just heard me talk about, which could be parts of project finance, CFA, MBA, is all taught because we are expected to use those tools in our work.
It's quite strange you say that, Saliya, because we have the same kind of sentiments that happen in our apparel industry. Because once they get into the apparel industry, they're so intensely working that they don't have time actually to study. So very interesting question coming out from a person called Roseka. She works in a company called Wavemaker. She's on the MBA program of Staffordshire. She's saying, it was very interesting for me to understand how this industry works. Do you see any light in the end of the tunnel as we owe the world $51 billion? Is there some way that these particular resources can come into the fray for us to cover our debt?
The simple answer to that is yes, but managing it and making it happen is in our hands. Ours is the government, really, because the private sector is not present in this field in this country, so we can't depend on our companies to step in and take risk. The government doesn't have to take risk. All it has to do is open the doors, create the right framework, and give the right stability and confidence. The value of the reserves far exceeds all of our debt combined. I think we did a conservative Bayesian modeling, which is to say you look at, based on one find, you look at other potentials, you de-risk them. In other words, you constrain them. In other words, give them the highest level of confidence possible. And then you multiply the potential quantity by market price, several $100 billion. So our 51 is easily manageable. Now, don't forget that not all of that will immediately come to the government. Government is a resource owner, so government gets a share. The people who invest in it are the people who take the first slice of the pie, they recover their costs, and then they keep to that defined and agreed level of return. So therefore, if it's a small reserve, they actually may make more than the government. If it's a large reserve, over time, the government will make much more. I hope that makes sense.
There's a question coming from Nishani. She works in the IT sector as a project manager. And the question she's saying is that, isn't there another model in which petroleum industry works, where you have virtually a stock exchange, where you can your reserves can be identified, and thereafter, based on that reserves, you can raise money just like a bank?
Nishani, that's a good question. What you are referring to is securitizing reserves and filing those reserves in the Securities and Exchange Council, so that you actually file. It's a balance sheet addition. So it gives you a stronger balance sheet against which you can borrow. Now that requires two things. One is your reserves have to be classified at 1P. In other words, proven. In other words, producing already and actually in the market. So we have to get to that point. Once you have producing reserves with a production profile and the ability to accurately model their future value or future worth, then you can consider them assets, file these assets, and potentially raise money against them. Now that's a different talk. That conversation happens with the bank. There isn't an exchange for such instruments, but there are oil and gas banks that do know how to lend against them.
Ishni is asking you, again, an MBA student, Saliya from Staffordshire University, and she's asking, there are two models that we kind of think this industry is in. One is the harvesting of the resource, and the second is the distribution of the resource. At which stage have we got into discussions on the distribution side of oil and petroleum?
Another good question, thank you. The harvesting part is what we call E&P, exploration and production. So we are at that stage. But the distribution stage is what we really call the downstream. So there's the upstream, which is the exploration production, and the downstream, which is the transport, refining, and distribution, the marketplace. In Sri Lanka, your question is very important, because unless there is a clearly identifiable market, then there is no discussion on E&P. So until and unless we give market confidence to oil and gas companies, we can't engage them on the upstream part, the harvesting part. And just to give you an example of what I mean, the difference between oil and gas is significant there. Sri Lanka is right now well known in the industry for having gas reserves. But gas, Ishni, is not transportable. Gas has to be consumed. The gas has to be produced in Sri Lanka and consumed in Sri Lanka. Whereas if it was oil, oil can be produced and it can be put in storage and it can be floated off on the ocean to any part of the world. So from that point, if we are going to get investors in gas reserves, we must give them market assurance. That market assurance comes in the form of a conditional gas purchase agreement. So that's as far as we have gone on the distribution side. We have to give them market assurance, which will justify their investment in the E&P. But thereafter, what they do with it has yet to be discussed. It is really their choice. But we have to buy it.
Interesting question, Saliya, coming up. It's from a guy called Pandula who works for a software engineering company, and he's saying, from the studies that we have done, this business is either in gas or oil. Which of these business are we closer to understanding our resource base?
If I understood that question correctly, you're asking about whether we are more predominantly gas or predominantly oil, and what's the difference between the business models? Yeah. If so, I'll answer that. Our discoveries thus far have been predominantly gas discoveries, but our modeling has shown many oil reserves as well. So we are quite interested in external partners coming in and exploring for oil. That would validate the oil theory. But at the moment, we have gas and light oil. Light oil is condensate. Now, that gas model is different from the oil model for the logistics reasons I explained to you before. If you don't have a gas market where you're producing gas, in other words, if there's no pipeline you can attach it to, or nobody who can liquefy it and export it, then you're not interested in making any investment on the upstream. Whereas if you are in an oil market, you know that whatever it is, you can produce it and you can store it and you can move it out at your convenience and at a later point. The difference in those business models is the gas model requires long-term contracts, long-term commitments to purchase to justify investment. The cost of producing these is quite high. What that cost in terms of oil is spread out over a shorter period of time than it is with gas. So you don't want to have any uncertainty in your gas contract. You want to be sure that you spend the money, you invest so much money, knowing that the returns are guaranteed by the contractual arrangement you have with the gas purchasers. So gas contracts, gas is produced into a contract typically, whereas oil can be produced into a spot. I don't know if that covers you.
Yeah. Shalini from an apparel company on the MBA program is asking, since you have been chairman of BOI and chairman of the Port Authority, and having a lot of exposure in the private sector globally, what advice would you give us who are studying for an MBA program?
I would give you the advice that whenever you sign off on making a recommendation for anything, be it a study, a design, a use case, test it as hard as you can, because ultimately your rise through the ranks in whatever business you're in will partly to an extent be based on the risk you take. So you must learn to take some risk in making recommendations and making choices, but use the right tools to understand what risks you're taking. So be bold is all I can say, but not foolhardy.
Oh, that was we have had many guests on this program, Saliya, and that question is a very favorite question that comes, but I think that was one of the best answers that I have heard, that in terms of moving up the career ladder is your ability of taking risk. And when you give a recommendation, how you evaluate that risk gives you the kinds of business maturity to tell you you're ready for that next move. Fantastic. Thank you so much. Fazli is asking, he's from JL Morrison's, again on the MBA program, Saliya. He's saying, Mr. Wickramasuriya, it's great to understand, the work that you're doing for Sri Lanka. What makes you to stay in Sri Lanka when people of your caliber have a global market?
That's very kind of you, Fazli. I have been in the global market for 30 years and I'm now 60 years old. So this is my home and these are my roots. I don't get paid much for what I do. So it's not for the money. I also don't necessarily, we all can do with more money, but I don't need the money per se, because a long time in the oil and gas industry does give you some kind of reserve. So I do it now simply because I can make a difference. And the day that stops, that's when I actually stop.
Fantastic. Thank you so much, Saliya. Another question is coming from Tamal. Tamal is asking, do you believe in Sri Lanka?
Yeah, I do. If you want to be more specific, I'll be more specific, but it's because I do believe in Sri Lanka that I am here still.
Superb, Saliya. Thank you so much. May I ask a few questions, Saliya?
Of course.
Anytime. Saliya, I'm not sure whether you had experience working in other markets, which has also got into this kind of a liquidity problem. Any advice that you would give in terms of how somebody needs to manage your career when our economy is kind of in a very strange situation like today?
That's a tough question to answer because I'm not in a career building position, but I have been a recruiter for a large part of the world and managing recruiters. So I can share with you some thinking there. The trend has gone from stable long-term jobs for life to churning and moving and learning from different jobs over a shorter period of time and capturing those learnings into building your profile. So I would say that in turbulent times, make use of that turbulence to churn yourself. Try a few different things, take that risk, and build your profile. There's nothing like a little hardship to firm things in your mind.
And Saliya, though a lot of people are looking at only Sri Lanka, the whole world is in a lot of illiquidity issues. In fact, World Bank said that there are 61 countries which are on the verge of this collapse situation. And they've in fact named those countries. But they also say that there's a huge recession coming to the European market, which can have an impact to the whole world. Do you feel that that will have an impact on anyone who is interested in the petroleum business?
Yes, it will, Rohantha. But that question allows me to say something I've been wanting to say for quite some time. So I'm going to take this opportunity. The European market is being stressed now because of its lack of access to lower cost Russian gas through Ukraine. So, ultimately it's being forced to kick power stations, coal power stations, nuclear power stations, import gas, a whole bunch of things that are more expensive than their prior dependence. So things are going to get more expensive when costs going up is tightening of money will result and the recession may well follow at some point. But the biggest threat to this industry is actually a welcome threat, and that is the threat of climate change. So really, before you even worry about economic conditions, liquidity crunches, depletion of reserves, as in fiscal reserves, the question to ask yourself is, must I, should I produce and burn fossil fuels? Because there is now there's completely compelling evidence that fossil fuels should be a fuel of transition at best, and a fuel of last resort. And that's where a career from this point onwards in the fossil fuel business is not suggested. I would say energy, sustainability, renewable energy, newer, different forms of energy conversion, fossil fuel based, but less carbon intensive. This is where to look for if this industry appeals to you. But people will still continue to produce oil and gas for quite some time. Don't get me wrong. It's just that there's a finite future if we continue to do it in an unconstrained manner.
One last question, Saliya. So right now there is a global crunch on this demand and supply of oil. Does that kind of facilitate somebody to look at a country like Sri Lanka?
It does, but keeping in mind that that would be a risk diversification and therefore a long-term play rather than an immediate market gain. We don't have there's no industry here, so there's no opportunity for arbitrage. If you are coming to Sri Lanka, it's to defray risk that you bring with your other investments, and you're looking at the long-term potential of our basins, which there is. So yes, a greenfield, virgin, unproduced basin is rare to find in the world these days, and we have one. So yes, there is a long-term appeal. In the short term, the volatility that you see in the market, supply and demand, it's something we have to insulate ourselves against, as a country. But I don't know if we can play that as a card for bringing somebody in.
Sorry, Saliya, just want to ask one more question. So does this mean that, are there any business models in how people have searched oil and gas? Is there some that we can pick up? Like I remember when I was working for Reckitt, whenever I used to talk about Dettol as a brand and I was running it, I used to be sent to Malaysia. And I used to ask the question, why am I sent to Malaysia and not to UK or any other parts of the world? And they said, no, Malaysian model is the best to understand how this market is going to evolve in the future. And you will also understand what you need to do. Is there some kind of lesson like that which is there, Saliya, in this business?
That's a great question, Rohantha. Thank you for asking it. I'm not sure if what I say will be the answer you're looking for, but there are business models, different business models in the resource extraction world, which is where we sit along with minerals and mining and all these other kind of resource extraction industries. And the world is divided into two. There is the concessional model and the contractual model. The concessional model is where ownership of that resource, say an oil and gas reservoir, is given to the company to exploit at their own risk and sell at their own risk and cost. And the owner relinquishes ownership in return for corporate taxation. That's one model. But so that model exists in the developed world, if I may say, the US, the UK, the North Sea, Australia, many places, many places, the resource is just given to the developer. The developer develops it, and if the developer is profitable, the government gets something out of it, and the government gets that out through tax. We live in a contractual world where we actually own the resource. It belongs to us. Us means you, the people, the republic. And we require that anybody who produces that shares it with us. And that's a slightly more economically difficult model to work with for oil and gas companies. Oil and gas companies like to be unconstrained by production sharing contracts, conditions, etc. So we are at a slight disadvantage. This contractual model is mostly prevalent in the developing countries. It's present in the Middle Eastern countries in a different way. Yes, the resource the state, let's say Saudi Arabia or the United Arab Emirates, owns that oil. But it pays per barrel produced. It's called a service contract. So there is a very clear incentive for people. Now in Sri Lanka, these two models, the concessional versus contractual, it's not up to us to debate because our mineral law is written and it would require a significant maturity in this field, which we don't have, to change from giving up ownership of the resource and giving it to the private sector and taxing them. We're not good at taxing in the first place. So if you give up your resources and then expect to make your money by taxing it, I think you're on a losing wicket there. But we can certainly make it more attractive. We can make the contractual regime that we have to deal with right now more attractive for investors. It's a long and complicated answer. I'm sorry, but I don't know if I answered your question.
Yeah. Thank you very much, Saliya. Really appreciate you spent 1 hour with the youngsters, and it's actually an honor to have you in a subject area that nobody can speak about in Sri Lanka. Very few, handful, and I think you're one of the best who has so much of experience in it. It's been a real honor to speak to you again, Saliya. And Ruth, are you around?
Thank you, Rahanta. Very kind of an old friend.
Yes, indeed. Mr. Saliya, I'd like to take it forward from where Dr. Rahanta left off. I'd just like to mention that it was really a pleasure and an honor to have you on our platform with your years of experience in this unique industry. Very few would venture, and very few parents would allow their kids to venture into. So it is a really humbling feeling at the moment, having heard your views and thoughts and knowledge on this sector. So thank you once again from all of us here at APIT, the students, alumni as well. So to end, like we always do, I would like to remind our industry partners who are part of our audience, not to forget our students when you have job opportunities available, as well as internship opportunities, because here at APIT, we have a well-structured internship program that we are following through. And we would like to join with all of you to help further the career development of our students. So with this said, I would like to send out a special thanks to our IT team at APIT for their technical support, as always, through adverse situations like power cuts and all. You have been there with us. To our students who have gathered, to our alumni, industry partners, and well-wishers, both in Sri Lanka and across the world. So thank you once again to each and every one of you. So from us here till we meet again next time, a good day, a good afternoon, a good evening from wherever you are joining in with us, and a good night. Take care till we meet again. Bye.
Thanks
Thanks,
very
Saliya.
much.
I appreciate Saliya.
Pleasure, always.
Thank you.